Theory is great, but nothing teaches better than real-life examples. Let's look at some investors who successfully grew their money by focusing on the US dollar and the stock market and learn exactly what they did right. Sarah, a 35-year-old marketing professional from New York, started investing seriously in her late 20s. She wasn't a financial genius, just disciplined. Her strategy was simple: focus on high-quality, dividend-paying US stocks and reinvest the dividends. She picked stable blue-chip companies like Johnson & Johnson, Microsoft, and Coca-Cola. By investing in US dollars consistently, she avoided complications from currency fluctuations and focused on compounding her returns. Over 10 years, Sarah grew a modest $20,000 initial investment into over $120,000, primarily through reinvested dividends and steady market growth. The key takeaways here are that compounding works best when applied consistently over time. Reinvesting dividends multiplies wealth silently, and patience beats hype, as she never chased trending stocks. Next, we have James, a 42-year-old software engineer from San Francisco, who decided to take a more aggressive approach. He understood that the US stock market rewards calculated risk. He combined growth stocks in the tech sector like Apple and Nvidia with ETFs to diversify risk. James also monitored USD strength because a strong dollar made international investments relatively more expensive, so he timed some purchases accordingly. By carefully balancing risk and reward, he turned $50,000 into over $300,000 in 7 years. He rode some volatile periods, but his diversified portfolio minimized losses. From James's journey, we learn that growth investing can be highly rewarding if paired with careful research. Timing purchases with USD trends can optimize returns, and diversification is essential even when chasing high returns. Then there's Maria, a 50-year-old nurse from Texas who aimed for early financial independence. She combined US dollar savings, dividend stocks, and index funds to build a reliable portfolio. She allocated 60% in index ETFs tracking the S&P 500, 30% in dividend-paying stocks, and 10% in cash reserves to seize USD opportunities. She leveraged USD savings to buy undervalued stocks during market dips. Today, Maria's portfolio is worth over $800,000, allowing her to retire comfortably at 55. Her story shows that early, disciplined investing pays off enormously. Allocating cash reserves gives flexibility during USD fluctuations, and combining ETFs with dividend stocks balances growth and income. Across all three cases, the lessons are clear. Consistency is king. Tracking USD trends helps maximize purchasing power and timing. Diversification is essential. Patience over hype always wins. And learning from mistakes while adapting is crucial. For actionable tips, start small, but invest consistently. Even $100 a month grows over the years. Reinvest dividends to maximize compounding. Watch USD trends to optimize buying power. Balance your portfolio with growth, dividend, and index ETFs. And don't panic during market dips. See them as opportunities. These stories aren't just inspiring, they're roadmaps. The next time you think investing is risky or complicated, remember Sarah, James, and Maria. They didn't guess, they planned, stayed disciplined, and let the US stock market and the dollar work for them. Now it's your turn. So after looking at all these real-life examples and strategies, the most important lesson is that growing your money in the US dollar and stock market is not about luck or guessing. It's about discipline, planning, and making informed decisions. Start by understanding the value of the US dollar and how it affects your purchasing power and investments. Track market trends, but don't let short-term volatility control your decisions. Build a diversified portfolio that combines growth stocks, dividend-paying companies, and index ETFs, and make sure to reinvest your earnings to take advantage of compound growth. Remember that consistency is far more powerful than occasional big moves. Avoid emotional investing, resist chasing every hot stock tip, and always keep some cash reserves ready to capitalize on market dips. Use technology to your advantage. Finance apps, robo-advisors, and investment trackers can make your life easier, but never rely solely on them without understanding the fundamentals. Most importantly, invest with a long-term mindset. Wealth doesn't grow overnight, but steady, informed investing leads to financial freedom and security over time. Now it's time to take action. Start small if you have to, but start today. Commit to learning continuously, track your progress, and adjust your strategy as you grow. The stories of Sarah, James, and Maria prove that with the right approach, anyone can succeed. Your financial future is in your hands, and every smart decision you make now compounds into bigger opportunities later. So, take the first step. Stay disciplined, educate yourself, and let the US dollar and the stock market work for you. If you found this video helpful, subscribe, like, and share so more people can learn how to grow their money. Remember, the sooner you start, the sooner your money starts working for you. This is not just theory, it's a roadmap, and your journey begins today. Investing your money in the US dollar and stock market is one of the most effective ways to build wealth over time, but it requires a clear understanding of how both work, consistent effort, and smart strategies. Many people think growing money is about luck or guessing the next big stock, but the reality is very different. The US dollar remains one of the strongest currencies globally, and the US stock market is home to some of the most profitable companies in history. To succeed, you need to understand not just the mechanics of investing, but also how macroeconomic factors, currency trends, and market psychology influence your portfolio. The first step in growing your money is understanding the value and behavior of the US dollar. The strength of the dollar affects everything from your buying power to your investment returns. When the dollar is strong, your savings and investments in USD can buy more internationally, while a weak dollar may reduce your global purchasing power, but could make US exports more competitive, indirectly affecting stock performance. Factors that influence the dollar include inflation, interest rates set by the Federal Reserve, geopolitical events, and global demand for USD-denominated assets. Investors who track these trends are better positioned to make timely decisions about when to invest, hold, or diversify their assets. Hedging against currency risk is another important concept for intermediate investors. Using tools like USD-focused ETFs or options can protect your portfolio from sudden dollar fluctuations, especially if you have international exposure. For example, if you anticipate the dollar weakening, investing in dollar-hedged ETFs or assets that benefit from a weaker dollar can preserve your returns. Understanding these fundamentals gives you a solid foundation for making strategic investment decisions. Once you have a grasp of the dollar, the next step is understanding the stock market itself. The US stock market includes thousands of companies ranging from small startups to mega-cap corporations. Key concepts for intermediate investors include market indices, ETFs, and different types of stocks. Market indices like the S&P 500, Dow Jones Industrial Average, and Nasdaq Composite give you a snapshot of overall market performance. ETFs, or exchange-traded funds, allow you to invest in a basket of stocks, providing diversification with lower risk compared to individual stock picking. Stocks themselves can be categorized as growth, value, or dividend-paying stocks, each serving a different purpose in your portfolio. Growth stocks focus on companies that are expected to increase revenue and profits quickly, often reinvesting earnings back into the business rather than paying dividends. Value stocks are typically more stable companies with lower market valuations relative to earnings, which can offer steady returns over time. Dividend-paying stocks provide regular income and can be reinvested to maximize compounding. Understanding risk versus reward is crucial for intermediate investors. Risk is inherent in all investments, but managing it effectively determines your long-term success. Time in the market usually beats timing the market, meaning consistent investment over years yields better results than trying to predict short-term price movements. Paying attention to US economic indicators, such as unemployment rates, GDP growth, inflation data, and corporate earnings, helps investors make informed decisions. For example, rising interest rates may impact bond yields and growth stock valuations, while strong GDP growth signals overall economic health, supporting stock market growth. With these basics understood, you can explore strategies to actively grow your money. Diversification is key. Spreading investments across stocks, ETFs, and bonds reduces risk while providing opportunities for growth. Dividend investing allows you to earn passive income and reinvest it for compounded growth. Growth investing involves identifying companies with strong potential for long-term appreciation, often focusing on technology, healthcare, and other high-growth sectors. Dollar cost averaging is a practical technique where you invest a fixed amount regularly, regardless of market conditions, which reduces the impact of market volatility over time. Technology tools, including robo-advisors, stock apps, and AI-based research tools, can streamline investment decisions, but should complement, not replace, your own research and judgment. Advanced techniques for intermediate investors include understanding options and derivatives for hedging,